In this example, we'll be doing practice exercise 16-4A that can be found in your textbook on page 756. We are going to be putting together the operating activity section of our statement of cash flow using the indirect method. They have given us some information regarding our company. They had a net income of $270,000, depreciation expense of $30,000, a gain on the disposal of their equipment of $24,600. They had a decrease in accounts receivable of $16,800 and a decrease in accounts payable of $4,320. So with our operating activity section, we always start with our net income. And for this problem, they told us that we had a net income of $270,000. We then need to make adjustments to reconcile net income to net cash flow from operating activities. Here is when we look at our income statement and look for any expenses that did not have a cash impact and any gains or losses from the sale or disposal of non-current assets. So they tell us that we have depreciation. Depreciation has no cash impact. Our adjusting entry for depreciation is a debit depreciation expense and a credit to accumulated depreciation. Therefore, depreciation expense reduces net income but would have no impact on our cash. So we will add back our $30,000 in depreciation. They also tell us that we had a gain on the disposal of equipment. We know that equipment is a non-current asset. So any gain or loss on any non-current asset is handled in our investing section of our statement of cash flow. Therefore, we do not want to double count that. So we are going to reverse the effect of this gain on our net income. We know that gains add to the value of net income, so we are going to subtract away the $24,600 gain. Those are the only two income statement items that we need to adjust for in this problem. Now we can look at the changes in our current operating assets and liabilities. And they've actually already calculated the changes for us. They tell us that we have a decrease in accounts receivable. Remember, when you're looking at the changes in current operating assets and liabilities, you need to consider how that impacts your cash. So, decrease in accounts receivable. The way that our accounts receivable decreases is when we collect cash from our customers. So our journal entry would debit cash and credit accounts receivable. So when our accounts receivable goes down, our cash flow actually increases. So we are going to add the $16,800 change in our accounts receivable. We also had a decrease in accounts payable. Our decrease was $4,320. So again, let's consider how that impacts cash. The only way our accounts payable goes down is when we pay off some of our debt. So again, if we were paying off some of our debt, we would debit accounts payable and we would credit cash, which means that our cash is decreasing every time our liabilities are decreasing, which means that a decrease in a current liability actually decreases our cash flow as well. We can now add together all of these adjustments. Don't forget to include net income to arrive at our net cash flow from operating activities.